higher interest rates are not going to smash gold over the long term, or even the medium term now. I mean, that's the thing we're seeing with oil and dollar going up together. Oil is just another commodity. Gold is also a commodity. It's a money commodity. So it's going to go up with interest rates also. It's going to go up with the dollar index also. That's what happened in the late 70s and into 1980. The biggest gold bull market ever happened at a time when interest rates were rising to like 20%, specifically then. That's the chase. That's the chase that we're seeing.
Gold prices dipped as the U.S. dollar strengthened and bond yields increased, with speculation arising that central banks might maintain elevated interest rates to combat inflation. The decline in gold prices on Friday, driven by expectations of higher interest rates and a stronger U.S. dollar, has significant implications for investors and consumers. Although the short-term outlook may see fluctuations, experts express confidence in gold's long-term value. Some market observers argue that gold could face downward pressure from higher interest rates as investors seek higher yields elsewhere. However, a historical analysis reveals no clear correlation between interest rates and gold. According to Rafi Farber, higher interest rates may not necessarily lead to a decline in gold's value, at least not in the medium to long term. He points to historical precedent, particularly in the late 1970s and early 1980s, when one of the most significant gold bull markets occurred concurrently with soaring interest rates, which reached as high as 20%. Farber also challenges the idea that a new monetary system could easily stabilize the current one. He suggests the existing system is inherently tied to gold, despite official denials. Any attempts to rescue the system, especially during crises, are likely to involve further inflationary measures. This could result in a nominal shift in the value of gold, whether measured in millions or trillions of dollars, while the core of the monetary system remains unchanged. Farber suggests that central banks might attempt to rescue the system by exchanging their bonds and treasuries with the Federal Reserve at face value. This year, central banks have already acquired $96 billion in treasury bonds, and positive valuation effects have increased their total holdings by $105 billion, totaling $3.544 trillion. Such actions could lead to a significant expansion of the Fed's balance sheet, driven by the accumulation of foreign debt, ultimately risking a potential U.S. dollar collapse. Now, let's watch the excerpts from Rafi Farber's interview with Manico64. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Higher interest rates are not going to smash gold over the long term, or even the medium term now. I mean, that's the thing we're seeing with oil and dollar going up together. Oil is just another commodity. Gold is also a commodity. It's a money commodity. So it's going to go up with interest rates also. It's going to go up with the dollar index also. The other thing I noticed was that the spread between the 10-year and the 3-month yield, right, that just broke through its 50-week moving average. And when that happens, it pretty much never reverses back down. And to get that spread up, if the Fed is going to leave short-term rates at 5.5%, which is where they are now in the 3-month, if they're going to leave them there and not cut, then the 10-year yield is going to have to go 300-400 basis points higher than it is now to even out the yield spread. If that's the direction we're headed in, it certainly does seem that way. And when it does, when the yield spread moves from negative to zero to positive, and once we cross that 50-week moving average, that's generally what happens, and there's no stopping it. Then that's when the financial crisis is very close at hand, and we're definitely on the way. First of all, they can't just come in with a new system and stabilize everything. That is impossible. The system is gold. They just don't. They just deny that. But but this is what I keep saying over and over. Because of the Misesian regression principle, the price matrix is still gold. Some argue it's silver. Fine. Still, you could say silver. I don't care what either one. But it is that. So there's no rescuing the system. All they can do is inflate, and they will do that. And at that point, it's really just a nominal question, right? Is gold going to be $35 an ounce, or is it going to be $35 trillion an ounce? But what's the difference? It's just 9 zeros. You just cut them off, and it's the same thing. That's hyperdeflation is hyperinflation. It's just in what terms? Hyperinflation is in dollar terms. Hyperdeflation is in gold terms. But it's all the same thing, right? This is all a nominal question. So yeah, they're gonna come and rescue. And what they might do is, they did the bank term funding loan with the regional banks. They said, you give us all your bonds, give us all your treasuries at face value. We'll give you face value for them. That's what they might actually do with other central banks that have all these treasuries. If Japan calls up the Fed and says, look, our treasuries, they're melting away and we're going to dump them on the market unless you want to do it like a private trade where we will give all these treasuries to you, Federal Reserve, and you give us the face value of them right now, or we're dumping them on the market. And they could really corner the Fed that way. I see that as potentially happening. And then what happens to the Fed's balance sheet? It just explodes with all the foreign debt, because if one country does this, the other countries are going to do this, and everything comes home to the Fed, and their balance sheet just like melts away into total negativity and negative equity, and then the dollar just collapses.
Rafi Farber emphasizes that the U.S. dollar index and oil prices seem to be moving in the same direction rather than their usual inverse relationship. Historically, a stronger dollar led to lower oil prices, but this correlation appeared to change in 2021 and 2022. If this trend continues, it could signify a financial crisis, primarily affecting banks, but not necessarily causing deflation in consumer prices. Despite such a crisis, inflation may persist, leading the Federal Reserve to print trillions of dollars to address it. This disconnect between financial markets and real-world prices could intensify as the endgame of the current economic system approaches. Regarding the bond market, Farber expresses concerns that it could face a sudden and substantial increase in interest rates. He speculates that many countries holding significant quantities of U.S. treasuries may eventually decide to sell them, potentially triggering a cascade effect. According to the Federal Reserve and the U.S. Department of the Treasury, foreign countries held $7.4 trillion in U.S. Treasury securities as of April 2023. As one of the largest foreign holders of treasuries, Japan holds $1.1 trillion, representing 4.4% of the total. If Japan starts selling its treasuries, it could significantly depreciate the yen and potentially set off a financial avalanche.
Oil was up like 3.5% yesterday, and the dollar index has been climbing pretty strongly for the past few weeks, week after week. I don't know the exact numbers. I'll look at the chart. I'm going to be talking about this on today's Silver Report, or it's going to be published tomorrow on Chris Marcus's channel on the Silver Report, how it looks like the dollar index and oil are now trading together, where they should be trading inversely, which is what they've always done, which makes sense. People think, and this is not the correct way to think about it, but it's sort of based on truth, or some true aspects of it, that the dollar is oil backed. It's not. But what gives the dollar a lot of its purchasing power is that OPEC oil can only be purchased in dollars. So the dollar is like sort of oil backed. So if the dollar goes up, oil goes down. That's how it's always been. It was certainly that way in 2008. But that changed actually in 2021, 2022. And it started to change. And now they're really trading together, the US dollar index and oil. And what does that mean? I can't say exactly what it means. I'd have to go into, when you try to figure out what this is, it's like you have to go into the reasoning why someone would buy dollars and buy oil. You can figure out the logic of why it would be inverse, but why would it be together? The only thing I can say in a broad sense is that the Forex market is starting to spin off or become disconnected from actual prices. Whereas that would mean that the next financial crisis is going to be strictly that. It's going to be a financial crisis strictly limited to the banks, and it's not going to affect consumer prices outside of it. We're still going to have that inflationary price inflation while the financial crisis is going on, which is going to force the Fed to appease the banks and print trillions of dollars to keep that going. But it's going to become more and more disconnected from actual prices. That's what we're going to see as the end game gets closer, and we're starting to see it now as the dollar and oil are trading together. The bond market is just going to proverbially fall off the proverbial cliff. I mean, the rates are just going to go up and up and up in a scary, scary way. And there's going to be no, technical buybacks or technical reversals. I mean, because if you think about it, like the entire world is loaded with this stuff for decades. And if the price keeps going down and down and down while the dollar's purchasing power keeps going down and down and down, because things like oil are going up and up as the dollar's going up. So like, what are these countries going to do? They're just going to sit on their treasuries and lose everything? I mean, at some point, they're all going to run for the door at the same time. And that's going to be it. It could be any point now.
Yeah.
I mean, and that's why I'm looking at the yen so carefully, because the biggest foreign holder of treasuries is Japan, and the higher the Japanese bond yield goes, the lower the yen goes, because the central bank of Japan owns the entire bond market. So basically, the yen is cooked. There's nothing they can do. They'll sell treasuries, and then the yen will get even weaker, and they'll sell more treasuries. This is what an avalanche is going to look like. And it could happen any day now.
The Federal Reserve's strict monetary policies will likely keep gold prices under pressure, causing ongoing market volatility. While current trends suggest a potential dip in gold prices due to higher interest rates, historical patterns indicate that this relationship is not always straightforward. What are your thoughts on the interview? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.